If you've built $1 million IRA, congratulations. But what if I told you the IRS already has a plan for your money and it starts the moment you turn 73? Required minimum distributions, or RMDs, are forced withdrawals from your IRA. And once they kick in, they don't stop, they grow and they compound. And they create a tax snowball effect that can cost you hundreds of thousands of dollars. The good news? You can stop the RMD chain reaction, but only if you act early. In this lesson, I'll walk you through the 6 critical reasons IRA millionaires should seriously consider a Roth conversion now before it's too late. If it's your first time here, I'm Dr. Amanda. Welcome to the Retirement Income School. This is your place for financial education to learn how to protect your wealth and generate guaranteed lifetime income so you can retire financially relaxed. All right, let's jump right in. We're talking about IRA millionaires and 6 reasons to do a Roth conversion before RMDs hit. So in this lesson, you're going to learn what RMDs are and why you must eliminate them, the 6 negative chain reactions of RMDs, and why a Roth conversion could be your solution. Now, of course, if you don't have $1 million IRA, you have something less. These numbers can be ratioed. This is really significantly going to affect you, though, if you have $1 million IRA or a larger IRA, because these chain reactions are exponentially more impactful when you have a larger IRA. So just keep that in mind as we're going through today's lesson. I want you to think about RMDs as a hidden threat to your IRA. If you've built up $1 million in a traditional IRA, that is awesome. Congratulations. Really pat yourself on the back. That's a significant nest egg for you. But the problem is that there's a hidden threat down the road, and it's called RMDs. Now, RMDs are required minimum distributions, and required minimum distributions are forced withdrawals that the IRS makes you take from your traditional accounts, IRAs, 401ks, starting at the age of 73 or 75, depending on when you were born. If you were born in 1960 or later, then your RMD age is 75, or earlier, 73. Now, RMDs are fully taxable and they grow larger every single year. There's also a 25% penalty for not taking your RMDs in time. Let me give you a step-by-step approach to calculating your RMDs. This is a very simplified formula. You would first want to write down all of your tax-deferred retirement accounts and your balance for each on December 31st of the previous year. So just have a list of those. And then step 2, you're going to divide each balance by your life expectancy divisor. Now, I have age 73 and 75 here. If you're a different age, just go to Google and type in life expectancy divisor for RMDs, and you'll see the chart there. So currently, at the time of this recording, for age 73, the divisor is 26.5, and for age 75, it's 24.6. And so you're going to calculate that by each retirement account. If you have a 403B or multiple 403Bs or IRAs and multiple IRAs, you can add those together so they're cumulative. But for any other type of traditional account, you're going to have to do them separately. So you want to take that full amount and then divide it by the life expectancy divisor. This will give you the amount that you're going to be forced to withdraw for that year for your RMD. The real problem with these RMDs is that they don't just increase your taxes, they trigger a chain reaction that quietly drains your retirement income and burdens your heirs. And that's what we're going to walk through in this lesson, these 6 chain reactions, and then I'll give you a solution to take care of this RMD problem. Let's start with chain reaction number 1, higher tax brackets. What this means is that every year you're forced to take out more and you pay more tax even if you don't need the money. And this RMD increases as you age. It's going to push more of your retirement income into higher tax brackets and reduce your net overall income. So let's say you're rolling along with your Social Security, pensions, maybe annuities, perhaps you're pulling money from equities, and you have plenty of money to meet your needs, but then you turn age 73 and all of a sudden you're forced to take RMDs, which increases your AGI, which causes you to move into a higher tax bracket. So that's chain reaction number 1. Chain reaction number 2 is Social Security taxation. Now, if you have $1 million IRA and you're already in a higher AGI, you're probably already being taxed on up to 85% of your Social Security taxes. So this one's very much going to depend on your current AGI. This is an additional impact when you take out those RMDs. Let's say you were right on the borderline of the 85% tax bracket for Social Security being taxed, and now you have an RMD and it pushes you over the edge, over that threshold. And so this creates a compounding effect when more of your retirement income is subject to taxation, again, further reducing your spendable income because you're being taxed at a higher tax bracket. So that's chain reaction number 2, Social Security taxation. Chain reaction number 3, Medicare premium surcharges. So this is called IRMAA, Income Related Monthly Adjustment Amount. And what's really wild is if you are a high income earner, you have a high AGI, and then you add high RMDs to your annual AGI, your income increases, which dramatically increases your IRMAA charges. When I work with high net worth people and we map this out, IRMAA charges can add up to $500,000 or more over your lifetime. And so this eats at your net worth and you lose the opportunity cost of that money that you're paying to IRMAA surcharges. And if you don't know what IRMAA surcharges are, it's that premium that you pay for Medicare that increases over time as your income increases. And there are 7 tiers in which you can be charged. So if you're in a lower tier, you're going to be charged less IRMAA charges. If you're in a higher tier, you get charged more. And IRMAA charges increase annually as well. On average, they've been increasing by over 6% per year. So not only do you have the inflation of IRMAA charges, you've also got now the potential of your RMDs being added, which is going to increase your overall IRMAA charges. So that's chain reaction number 3, Medicare premium surcharges. Chain reaction number 4 is lost tax benefits. So as your income increases, you lose tax deductions. So things like the QBI, which is qualified business income deduction, can decrease as your RMDs increase. You can lose energy credits. Things like home improvement and energy efficient tax credits can be reduced or even eliminated. SALT deductions can phase out. So that's the state and local tax deduction benefits. They can diminish as your RMDs increase, and education credits. So let's say you're helping your grandkids go to college, you might lose college tax credits as your RMDs increase because your income becomes too high. So that's chain reaction number 4, lost tax benefits. Chain reaction number 5 is called the widow's penalty or the widower's penalty. And what this is that when one spouse passes, the survivor gets taxed higher as that surviving spouse moves from married filing jointly to a single taxpayer rate. So you have the same exact income, but much higher taxes. That's called the widow's or widower's penalty. And this very much negatively impacts the surviving spouse. And that's chain reaction number 5 of RMDs. Chain reaction number 6 is that your legacy becomes a tax burden. So under the Secure Act, kids must empty inherited IRAs within 10 years. And if you think about this, this causes a tax acceleration problem for your heirs because your heirs are forced to take distributions during their highest income earning years, maximizing instead of minimizing their tax impact. So if you think about this, let's say that you pass when you're 85 or 90, your kids might be in their 60s, 50s, right at their highest income earning years. So they're already in a high tax bracket. Now you're adding this IRA tax burden because they're going to receive this inheritance from you, which is awesome. I'm sure they're grateful for it, yet you're kicking them into the highest tax bracket. And it doesn't have to be this way with proper planning. And additionally, there's no escape for them. There's no way for your heirs to avoid this massive tax bill on inherited traditional IRAs because someone has to pay taxes, right? And so when they inherit that, they're going to be adding income to put them into a higher tax bracket, which is eating away at the inheritance. So that's chain reaction number 6. Your legacy becomes a tax burden. Let's recap these 6 RMD chain reactions. Number 1, higher taxes every year. RMDs force you to take out more income, pushing you into a higher tax bracket. Number 2, your Social Security gets taxed. Up to 85% of your Social Security benefits can become taxable. And like I said, if you're already in a high AGI, this is probably already happening to you. Number 3, Medicare IRMAA surcharges. So you could pay over $500,000 in your lifetime in Medicare penalties or higher surcharges. Number 4, there's a loss of tax deductions and credits. So RMD income phases you out of tax breaks. Number 5, the widow's or widower's penalty. A surviving spouse pays more taxes on the same exact income. And number 6, your heirs inherit a tax time bomb. So because of the Secure Act, they're forced to drain that traditional IRA that you gave them, that they inherited, over 10 years, likely at the time when they're at their peak earning years. So they're going to be in the highest tax bracket. Now, this all sounds pretty awful, and I always like to bring you solutions. So what is your solution? A Roth conversion. By proactively moving money from your traditional IRA into a Roth IRA, you eliminate future RMDs. And in doing so, you stop the chain reactions before they start. And I just released a lesson on Roth conversions and how important it is to look into these during the 2025 to 2028 window. If you're listening on the podcast, it's episode number 16. And if you're on YouTube, then you'll see the link flash by on this video, or the link is in the show notes. And you can, of course, watch that and dive in more deeply. But to recap that here, the reason you want to consider a Roth conversion is because once you convert your traditional IRA into a Roth IRA, now all the growth and all the payouts are tax-free for the rest of your life. And then when you pass it on to your heirs, it's tax-free to them. This is going to eliminate all of those chain reactions that we just talked about before they even start, as long as you act early and you get the conversion done prior to age 73 or 75, depending on when you were born. And what's really cool is that I've got specialized Roth conversion software that helps us strategically convert your IRA over time. And this can be done with 3 very powerful benefits. Number 1, no out-of-pocket cost. 2, no principal balance reduction. And 3, you stay in the same tax bracket. And of course, this is going to be a unique to you blueprint where we look at your AGI, the amount that you have in your traditional IRA or 401k, and we strategically convert over a number of years based on your unique situation. And so our goal is to have no direct out-of-pocket costs. This is something that prohibits people often because they go, well, if I convert from traditional to Roth, I'm going to take a huge tax hit. But the way that we do this is by using a Roth-friendly annuity, where the growth in the annuity with the bonuses and then the annual growth, that pays the taxes, so you don't have to come out of pocket for your tax payouts from converting your traditional IRA to a Roth. Another reason we use a Roth-friendly annuity is that it protects your growth. So you get market-linked returns with downside protection to preserve your hard-earned retirement savings. There's also the option for guaranteed income, so you can get guaranteed secure tax-free income for life. You don't have to worry about market volatility, performance, or longevity. This also gives you a tax-free legacy, so you're going to create a lasting legacy to leave to your heirs without tax burdens. And in these Roth-friendly annuities, we use A-rated annuity companies that have stood the test of time, and you can opt into a growth annuity because maybe you don't need annual income, and instead you choose a growth annuity. So we've got income annuity and growth annuity options, all with A-rated Roth-friendly companies. There are 737 annuity companies. There are only 5 that are Roth-friendly. So it's very hard to find these unless you know the right person to talk to. I'm one of those people. And I map out a Roth conversion blueprint for you to help you know the exact numbers. Typically, we do this in collaboration with your CPA so that we make sure that we're checking all the boxes and keeping you in the right tax bracket. And so that's how this works, to think about doing a Roth conversion using an annuity. If this sounds interesting to you, go to retirementincome.school. You'll see a button at the top of the page that says book a Q&A call. Book a call with me. We'll chat about your unique situation, and we can see if a Roth conversion is a good fit for you, dependent on your AGI, your current income amount, how much you have in your traditional IRA, and your timeline for converting. Could be a great fit. There might be other options we can look into as well to help you protect your wealth and decrease the impact of taxes. So again, retirementincome.school. I would love to talk to you about a Roth conversion or other retirement income options if a Roth conversion doesn't fit. And thanks for being here for another lesson. If you haven't subscribed to the podcast or YouTube channel yet, be sure to do so now. Turn on the notifications so you never miss out. And keep on hanging out with me here in the Retirement Income School, where I'll teach you how to keep your money safe and make it last so you can enjoy retirement. This content is for educational purposes only and is not financial, legal, or tax advice. Always consult a qualified professional before making decisions about your retirement.